Welcome back to Financial Statement Analysis, Chapter 4, the Analysis of Inventories. In this chapter, we are going to talk about the cost of inventories, the inventory measurements, reporting of inventories on the financial statement, inventory valuation methods, inventory and cost of goods sold, how we are going to measure it, Fifo and Lifo, what is the impact on the income, cash flow and working capital, what are the advantages and disadvantages of Fifo and Lifo, and how it impacted on the financial ratios. Finally, we are going to talk about Fifo and Lifo, Lifo reserves and Lifo liquidation, and adjustments relating to transferring from the Lifo basis to Fifo, as well as the reasons for the declining in Lifo reserves. And we'll see how we can make a choice in between whether we are going to Lifo or Fifo. So let's move on to the next one. So let's see what is inventory. So inventory is defined as the asset that are intended for sale and are in the process of being produced for sale or are being used in the producing goods. The following equation expresses how a company inventory is determined. So we are going to take the beginning inventory or the opening inventory, then we are going to add the purchases, then from that we are going to deduct the cost of goods sold to come to the ending inventory. Now let's see the importance of inventory. So these inventories are the major factor in the analyzing the merchandising and manufacturing companies. Such companies generate their sales and profit through inventory transactions on regular basis. An important consideration in determining profit for these companies is measuring the cost of sales when inventories are sold. So now let's see what are the cost of inventories. The cost of inventory comprises with the cost of purchase, the cost of conversion, and other costs including to bring the inventories to their present location and condition. These costs has to be capitalized and included in the current asset under the inventory. The storage cost of finished inventory, the abnormal losses due to wastage has to be treated as the expense in the period and they have to charge into the income statement. So now let's see the inventory measurement base. According to the LKS2 inventories, the inventories are measured at lower of cost and net realizable value. You know, the net realizable value is the estimated selling price in the ordinary course of business less than the estimated cost necessary to make the goods into sale. So let's see what are the reporting of the inventory in the financial statements. So you know that inventories are three types: finished goods, work in progress, and raw materials. This inventory is an asset and its ending balance is reported in the current asset section of the company's balance sheet. This inventory is not an income statement account. However, the changing inventory component in the calculation of goods of sold, which is often presented in the company's income statement. An increasing inventory will subtract from the company's purchase of goods, while decreasing inventory will be added to the company's purchase of goods to arrive at the cost of goods sold. So there are three inventory valuation methods we can see. First in, first out, Fifo method. Last in, first out, Lifo Method, weighted average cost. So what is the focus on the analysis? The choice of inventory method affects the financial statement and any ratio that are based on them. As consequence, the analyst must carefully consider the inventory valuation method, the difference between the evaluating company's performance over the period of time in comparison to the industry data as well as industry competitors. The company must use the same cost formula for all the inventories having similar nature and use to the entity. The changes in carrying amount within the inventory classification, such as raw materials, work in progress, and finished goods, may provide the signal about company's future sales and profit. The inventory turnover ratio, or the number of days of inventories, and gross margin ratio are useful in evaluating management's the company inventory and their usage and their effectiveness. Now let's see the inventory cost and cost of goods sold and how it impacted on the FIFO and LIFO basis. When there is an inflation, all the prices of the inventory will go up. So in the case of FIFO, since the first comes are going first, the remaining balance will show the inventory which is relating to the current price which are higher. If the costs are increasing, the items acquired first were very cheap. The decrease in the cost of goods sold under the FIFO method can be seen. Since the cost of goods sold is decreased, you can see there is an inverse relationship and there can be an increase in profit. Since the profit are increased, the income tax will be larger and the value of unsold inventory also be higher. So what will be the impact on the LIFO basis? In the LIFO basis, the last come is going first and the remaining balance will show the earliest price which is cheaper. If the costs are increasing, the recently acquired items are more expensive. This increased the cost of goods sold under the LIFO method. And as a result, there will be a decrease in net profit. Since the profit is lesser, the income tax will be small. As well as the value of unsold good of the inventory is lower in the current assets of the statement of financial position. Now let's see the effect of deflation. Deflation means the current price is gradually decreasing. When there is economic boom, we can see a reduction in the price. So this is converse to the inflation scenario. Here, under the FIFO method, in the deflation period, the value of unsold inventory will be lower. If the value of unsold inventory will be lower, what will happen to the cost of goods sold? It's opposed to the inflation scenario. Likewise, the same impact can be seen under FIFO method. During the deflationary period, both accounting profit and value of unsold inventory will be higher. So we can see this in the summary of chart as well. In this one, you can see in the pricing price, since the material cost is higher in the LIFO method, right, the closing stock will be lower. But in the FIFO method, the purchase cost is lower because in the previous area, we have purchased it cheaply. But the closing stock will be higher because of this inflationary scenario. Now, when there's a decrease in price, the material cost will be lower under LIFO method. But what about the FIFO method? the purchasing cost is higher because of the decrease in price. Then the closing stock. In the LIFO method, we have the earlier stock now. So this is higher and the current price is cheaper. As a result, closing stock is higher under the LIFO method. So in the FIFO method, because of the gradual decrease in price, our closing stock will be lower. So let's see the LIFO versus FIFO for the income, cash flow and the working capital. So what will be the impact on the cost of goods sold and the income? Since the LIFO affect the most recent purchase price to the cost of goods sold, the use of LIFO result higher cost of goods sold and lower reporting income. In contrast, FIFO allocate earliest purchase price to the cost of goods sold, resulting lower cost of goods sold and higher income. So what will be the impact on the cash flow? And what will be the choice of LIFO and FIFO and its impact on the pre-tax cash flow? So you know that pre-tax cash flow is determined by the cash inflow from the sales and cash outflow from the purchases. Neither of them will affected by the method of inventory accounting. However, the choice of FIFO and LIFO affect the tax payment. Right? Because of LIFO, we have the higher price at the closing stock, and in the FIFO we have a cheaper price in the closing stock. So since we have a lower price under the LIFO method, the tax income liability will be lower since our profit is lesser. Under the FIFO method, if we have higher inventory figure, this has indication of higher profit figure as well. If the profit figure is higher, we have to pay more tax for the company. Then what is the impact on the working capital? Working capital is defined by the current assets minus current liability. Since LIFO report lower inventory than FIFO method, working capital will be lower under the LIFO method. So you can see the impact on it to these ratios as well. So to the cost of goods sold, tax, net income, in the balance sheet, inventory balances, working capitals, cash flow statement, you can see in this chart as well. So now let's see what are the advantages of having this FIFO method and what are the disadvantages. The advantages is it's really easy to apply. It assumes the flow of cost corresponded with the normal physical flow of goods. No manipulation of income is possible under the FIFO method. The SFP amount of the inventory is likely to approximately reflect the current market price. Under the FIFO method, the purchase at the end of the period have no effect on the cost of goods sold or the net income. But there are some disadvantages as well. So this is recognition of the profit in a paper profit rather than the actual profit. There will be a heavier tax burden if it used for tax purpose in the period of inflation. Therefore, most of the people suggest to go LIFO method when there is an inflationary situation. But you know, according to the LKS 2, they only allow FIFO or weighted average in the inventory valuation purpose. Now let's see what are the advantages and disadvantages of last in first out method. In the last in first out method, it matches the recent cost against the current revenue. Tax benefit and improvement of cash flow can be seen. LIFO will minimize the written down cost to the market because it reflects the current market value. and the physical flow of inventory is smoothly going because they are issuing the recent inventories. But there are some disadvantages. It will reduce the earning in the inflationary times as well as it underestimate the inventory. There is also something that called Lifo liquidation. So that's the disadvantages of the Lifo method. So let's see what is the impact on Lifo and Fifo for the financial ratios. The profitability ratios, mainly the gross profit margin, is come up with the gross profit divided with the sales. This gross profit is the difference between the sales minus cost of goods sold. The LIFO give more accurate forecast for the firm prospect by removing the impact of the price changes. Therefore, if we are using LIFO method, we can have increase in gross profit margin. What is the impact on the liquidity? Mainly the working capital. You know, the working capital is current asset minus current liabilities. Actually, in the FIFO method, our inventory value is higher than the LIFO method. Therefore, LIFO misstates the working capital because the inventory component of the working capital report may be outdated and is small. Because of that, our working capital will be lesser in LIFO method. Then what is the impact on the activity ratios or the inventory turnover ratio? Actually, the inventory turnover ratio reflects the cost of sales divided with the current average inventory. So, since the average inventory is meaningless for LIFO method, the inventory turnover ratio will not reflect the true figure. Therefore, to reflect the true figure, we have to convert it to the FIFO method. So, let's see the other ratios as well. Now, in this one, you can see the profitability ratio, the profit margin, and the impact of the ratios which is relating to the inventory valuation. Please go through this carefully. So, here you can see a snapshot of the ratios, the ratio and the impact. According to this, you can see the inventory turnover is higher in the LIFO method and the days of inventory is lower in the LIFO method. What about the total asset turnover? Total asset turnover is higher under the LIFO method. The current ratio. According to that, this current ratio is the current asset minus current liability. Since the inventory value is lesser, it will less the current ratio as well as the quick ratio. What about the cash ratio? Here, the cash will be divided with the current liability. Since the cash amount is lesser under the LIFO method and the current liabilities are in the same way, we can see a higher under the LIFO method. Then gross margin will be lower under the LIFO method and return on asset also lower under the LIFO method. So debt equity ratio is higher under the LIFO method as well. So let's see the LIFO reserve and LIFO liquidation. So what is the need for this LIFO reserve and LIFO liquidation? The difference between the LIFO and FIFO comparison is very difficult. Therefore, to make it easy, we are going to make an adjustment to the financial statement of the LIFO funds. For that, we are going to use this LIFO reserve. LIFO reserve is the amount by which LIFO inventory is less than the FIFO inventory. Here, the LIFO reserve is the difference between the FIFO valuation minus the LIFO valuation. LIFO reserve is used to bridge the gap between the FIFO and LIFO cost when the company uses LIFO method to track its inventory but report under the LIFO method in preparation of its financial statement in the period of rising prices. So, the result of this will reduce the inventory cost in reporting in the statement of financial position. So let's see what are the adjustments from LIFO to FIFO. The first adjustment is we have to add the LIFO reserve to the LIFO inventory in the statement of financial position. Then we have to deduct the excess cash saved from lower tax under the LIFO method. Then we have to increase the retained earning component to the shareholder by the LIFO reserve. Finally, in the income statement, we are going to make the cost of goods sold of the LIFO, and we are going to change it under the FIFO company method because it will useful to the investor to analyze between the industry. So this is the final equation we can use to compare the FIFO and LIFO inventory costs in the income statement. So let's see LIFO liquidation. The LIFO liquidation occurs when the number of units of the ending inventory decline from the number of units that were present at the beginning of the period. If the inventory unit costs have generally rising from the year to year, this will produce an inventory related to the increase in gross profit. This management can use LIFO liquidation to inflate the earning artificially. Further, LIFO liquidation can also occur due to events that are out of the management control, such as strikes and managerial shortages. So let's see what are the factors or what are the reasons result in declining in the LIFO reserve. The first one is LIFO liquidation. As I mentioned you earlier, this is the practice of selling or issuing of the older merchandise stocks or materials in the company inventory. Therefore, the old inventory cost remaining on the inventory valuation method. The liquidation occurs when the company using LIFO to sell more goods or issue more old stock than it buys. When there is a decline in price, the deflationary environment, the LIFO reserve have a negative balance. This will caused by the LIFO inventory valuation being higher than the FIFO valuation. Then what is we are going to use? LIFO or FIFO? There's a choice. So this choice is reflected by considering the following factor. How much of tax can be saved? We know that in the LIFO method, the profit is higher. So we have to pay more tax. Then the inventory materiality. In the LIFO method, the inventory is less significant than the FIFO method. So what we are going to select? It's a questionable. Then the tax loss carry forward. Inventory variability. If the inventories are varied over the period due to seasonal fluctuations, cyclical fluctuations, and random fluctuations, what we are going to use? Then, if the inventories are obsolete more rapidly, we can't go for the LIFO method because in the LIFO method, the old inventory may be obsolete frequently. Then the leverage, debt to equity ratio. What is the impact? So in the capital structure, where we are going to state it. So based on these factors, the LIFO and FIFO choice is a discretion of the management. But remember, according to the LKS 2, we have to go for LIFO or FIFO. We have to go for FIFO as well as the weighted average method. Thank you, and we'll meet with some more questions with regarding to this inventory valuation in the next session.